I have three equity curves on my screen. They all belong to exact same system. This is a mean reversion trading system that I trade in my own portfolio, and I traded in all US stocks. Now, the only difference between these three equity curves is that one version of the system doesn't use any stop loss, and other two versions use stop loss that's based on a certain multiple of indicator called ATR. Now, which of these equities do you think is the one that doesn't use any stop loss? And you may be surprised to hear that the version that doesn't use any stop loss and would be considered risky by most traders is the one that has shown the greatest amount of profit in the backtest, which is the turquoise equity curve. What I want to do in this video is I want to kind of cover the logic of using stop losses in your trading strategies, and more specifically I want to explain why I don't use stop losses in my own trading strategies and what to do instead to lower your risk and at the same time increase your profit potential as well. Before we get to that though, my name is David and my channel is called Critical Trading. I share different tips and tricks what to do in your own algorithmic trading. I give you ideas to test and possibly develop into your own trading strategy. So if that's something you're looking for, make sure to subscribe to my channel. Not only are you helping me by doing that, but you are potentially helping other people as well, because there is a higher chance that they will discover my content as well and potentially get something valuable out of it for themselves. Now, the rationale behind using stop losses in your trading is that you basically want to minimize your risk or keep control of your risk by having a certain limit as to what you can lose on a single trade while retaining your return potential. Now, this actually makes a lot of sense if you just, think about it this way, but does it actually work that way? The answer is not that simple, and I think the answer would be different for different trading approaches. I primarily just trade mean reversion these days because mean reversion is quite specific in what it trades. It doesn't actually make much sense to be using stop losses in mean reversion trading strategies. And what I want to talk about is what to do instead in order to minimize the risk. So let's just have a quick look at the results of these three different strategies that I had equity curves of on my previous screen. The version of the system with no stop loss is showing the highest rate of return. Of course, when you are trying to control risk, you will always pay for it by lowering your returns. So that's fine. So we shouldn't be just looking at the rate of return itself, but we should be looking at the rate of return that's associated with a certain risk. And we can look at that risk as a maximum drawdown. So the original version has got about 27% rate of return and associated almost 10% maximum drawdown. So if we then take this strategy and start trading it with a stop loss on each trade, while our maximum drawdown went down by about 1%, our rate of return went down from 27% to 9.5%. So we have lowered our maximum drawdown a little bit, but we have significantly lowered our return potential at the same time. So this is really not a good way to go when it comes to mean reversion strategies. When it comes to mean reversion trading strategies, what you are doing is you are essentially buying against a short-term momentum, so against the short-term pullback, like for example on this chart that I have on my screen now. In order to have the odds on your side in the long term, you need to ensure that you give that trade enough room, because you never know at which exact point is the market going to reverse. It may be right at the point of your entry, which happens sometimes, but not often. It can be 5% below your entry. When you trade mean reversion in the stock markets, what you are bound to realize at some point is that your biggest losses will always be driven by the outlier trades that, open 5% below your maximum stop loss anyway. And the thing is, you will get filled at that price. So the stop loss doesn't actually happen, but in the long term, it's just going to hurt your performance. So there are other options how to control the risk when it comes to trading, systematic trading strategies in a portfolio. You can simply allocate less capital to a strategy. you can have the strategy to trade more positions at the same time. But there is one more thing that I would like to share today, and that is simply adding a different strategy and then having them to share their capital in a portfolio. So let me give you an example of that. So on my previous screen, I had an example of a typical mean revertive movement. So you are waiting for a certain pullback. You can measure that pullback by how far is the current closing price of the stock stretched below the certain moving average. I've actually got a video on that where I tested, I think, 10 different mean reversion setups on SPY. So make sure to check that out. I'll put the link in the description. But irrespective of what exact mean revertive setup definition you use, what you're going to find is that most of your setups will be generated on certain days. So when the overall stock market is making a pullback, so generally on the red days in the SPY. But whereas when the overall stock market is rising, you're not going to get enough setups. So what if you use that and try to build a different strategy? It will be guaranteed that it will be getting setups in a different market environment. So for example, I'm just working on a strategy that will basically wait for a green day in the stock market. So it doesn't really work with a typical pullback definition. And then it would try to buy in a situation like this when the market, after making an up day, opens below the previous day's low. Okay, so it would still buy on a pullback, but the pullback has got a very, very different definition to the previous ones. So what if we then combine these two strategies? Would we achieve the same effect as when using a stop loss? So would we control our risk, but at the same time we would retain the return potential, or ideally we would increase it? So let's have a look. Again, I've got the results of the first strategy that I was talking about previously. The original version is right at the bottom, so that's the original version that doesn't use any stop loss. And then I have two more versions of it, both of which using stop losses and both of which have poorer performance overall. And I've just added one more row to my results file, and that is the combination of this first strategy with the second strategy that I roughly described just now. And both of these strategies are traded alongside each other on slightly different market universe, but they are both using the same capitals. So we are using same capital for both strategies. So we are essentially using a margin. However, because these strategies trade in very different market environments, the chances are when one strategy is getting signals and entries, other one isn't. Okay, so we can afford all of that thanks to the nature of mean reversion strategies. And at the same time, our maximum drawdown has gone down despite now using margin, so using a little bit of leverage with our capital. But look at the rate of return, that has gone up massively. And that is because both strategies are different. Both strategies trade the same capital, but at the same time, because they hedge others so well, the risk has actually gone down. So the takeaway here is that if you are trading on a portfolio level, so you are trading different strategies, what makes much more sense than implementing stop losses that are not going to save you from, the outlier movements anyway, is combining them and possibly having them to share the capital. That is a very, very strong technique that I personally use. And just to show you an example on the equity curve, this is a 1 year's worth of trading activity for the second strategy. I think this is year 2019. And we can see that if you traded this strategy on its own, like most people would, you would struggle because you would get into an open profit, halfway through the year. But then for the rest of the year, the equity curve basically goes sideways. And in hindsight, when you look at the entire history of the backtest, it doesn't seem so significant, but in reality it really, really is. And then let's have a look at the second strategy, and we can see that because they both trade very different mean revertive setups in different market environments, one strategy is doing quite poorly while the other one is doing great. And that's exactly what you want to achieve. So the takeaway from this video is that it's, in my opinion, not a great idea to be going down the route of implementing stop losses in your trading strategies, but I think it's a much better idea to trying to control the risk on a portfolio level by using different strategies that are not correlated to each other and that complement each other well. Not only is it easier to execute because you are smoothing out your equity curve and your returns, but you can also improve the overall return potential while actually minimizing your risk. So thanks very much for watching. This is David at Critical Trading, and see you in the next video.